Good morning, everybody. This morning, we are going to focus on US stock market indices. So I'm going to talk about the S&P and the NASDAQ 100. Then I'm going to give you an update of what's happening on US 10-year bond yields, which are reaching an important support at 3%. And we will end with an update on what's happening on the US dollar. So first of all, if we start with a chart of the S&P 500, so the S&P is trading in line with what I told you over the last few weeks, which means that we indeed started to see a technical bounce above the 2600 area, which remains a very, very strong support, and which I think will hold by year end. So what happened this week with the Fed is a confirmation of a new technical bounce on US stock market indices, which was very strong on Wednesday evening. And I think it will mark the start of the well-expected December rally, which will probably continue until the end of the month and of the year, possibly back to 2820. Which is more or less the Fibonacci resistance which was previously hit, and also more or less the chartist resistance zone we see here. So it means that the S&P 500 could go a bit higher, could go a bit above this level. The next Fibonacci resistance and the ultimate one being around 2860. So you can see it here. So this would be my maximum upside target for this technical bounce. In the medium term, however, it's not necessarily because the S&P is bouncing back right now and is due to rally by year end that we will start a new bull market. This year has been a very difficult one. With a big trading range, a very complex trading range forming since January, February, so since the beginning of the year. And from a long-term point of view, as previously discussed, I showed you the top, how the top formed in 2000, for example, and in 2007, I think it was 2 or 3 weeks ago. And what we can see is a potential top formation, so a possible major top formation on the S&P 500 this year. So this could be a distribution process, which means that next year could be quite negative for the S&P after a year of top formation in 2018. So it's not because I expect a continuation of the technical bounce in the short term that I turn outright bullish on the S&P. On the opposite, I think the S&P is deteriorating from a long-term point of view. If we now look at what's happening on the NASDAQ, so similar outlook. The good news is that the NASDAQ is bouncing off an important support zone, which is located between 6,500 and 6,250. This is quite positive in the short term. I think we have seen an important low, at least in the short term. And I think that on the NASDAQ 100, the rally will continue, possibly back to the 200 moving average, which is also a Fibonacci resistance. So that's around 7,100, possibly higher, possibly up to 7,200, maybe 300, max 400. Once again, it's not necessarily because the NASDAQ is bouncing back and is making a rally in December that we will start a new uptrend. On the opposite, I think it could be just a temporary relief rally, and after that, so later on in Q1 of last year, possibly a new significant correction, and this one could be even steeper. If we now look at what's happening on bond markets, a nice technical bounce over the last couple of weeks, even on US bonds. We can see that US bonds are moving back close to 3%. 3% was my trading target for the rally, and it's also a very strong support, and I don't think that bond yields will drop significantly below this level by year end. Even if it does in the short term, we can see that there is the 200-day moving average just below this level, so at 296, so you can see it here. And another key support line is located at 290. So overall, a pretty limited downside potential on US bond yields, and risk longer term of a new technical bonds back to year highs around 325. I will end this presentation with a focus on what's happening on the dollar index, on the US dollar in general. This is a chart I showed in my weekly report on Wednesday. So as you can see, the negative news that the dollar index is still trading below a major resistance, a major Fibonacci resistance, which is located around 98. 98 remains a very, very important resistance, and we continue to see sideways trading below this level. On the opposite, we haven't seen yet a significant bearish reversal on the US dollar. The recent correction was not convincing, and prices even failed to hit their rising to 50-day moving average. So it shows that the market is not very clear on the next step on the US dollar. Personally, I continue to favor a consolidation below 98, so below this resistance, but I must admit that the market has not yet confirmed the scenario of a correction. If we now focus on what's happening on euro-dollar, so this is more or less a reverse chart, you can see the Fibonacci support around 112, and another one which was tested numerous times over the last couple of months at 113. So what we can see quite interestingly this week is that the euro-dollar tried to break below this level, so 113 at the start of the week, but quickly bounced back above it. So it's the second time we saw a false breakdown below 113, and it thanks to the Fed. This time it was thanks to the Fed, and it shows that the bullish scenario, so the possibility of a bullish reversal on euro-dollar is still possible, is still likely. So let me check. Yeah, I will show you a potential pattern. So this one is new, which could be a reverse head and shoulder. So I don't know if you see it, but you have the left shoulder, the head, and the right shoulder here, which could have been made this week. So a breakout above the neckline, which is slightly below 115, would validate the target, and the upside target could be between 117 and 118. So quite interesting upside potential, and something to monitor in coming weeks. Have a very good day and a nice weekend.